Here in the U.S., of course, we're expecting also the CPI numbers to come out next week on the first day of the Fed policy meeting. In this environment, how do you position?
Well, I think we're expecting, everything being equal, a hawkish pose. We've seen some deceleration, mild decelerations, as you know, of inflation. And I think we will see what the message is for July, but a hawkish pose would be warranted at this point in time for the Fed.
What does that mean for tech stocks? We have seen a little bit of a downturn for those big mega cap tech names, but at the same time, of course, we see this huge frenzy around AI, even in an environment of rising yields.
Yes, exactly. So I think, as you know, AI has been a very long-term theme for us. We've had it for many years, including more generally technology and cyber security, which is even more important in a world where AI takes a larger share, if you want, of technology. I think given the rally that we've had, it would be normal to see a bit of a pause, particularly in the context that we see where rates might plateau quite soon but stay higher for longer. In this environment, you'll have opportunity. This is not an area where you buy an ETF. This is an area where you really do a lot of work from the bottom up, stock picking, and you really position the portfolios for the long term, because the trend will continue to stay with us for the long term.
Yeah, but I suppose is there a split between pre-regulatory crackdown and post-regulatory crackdown when it comes to AI, though, because there does seem to be, you know, that reckoning that will be coming in markets like the US, but also in China.
Yes, absolutely. So I think, you know, AI is not one thing. One element of it is what I call digital Darwinism, which will actually play an enormous role in competitiveness between countries, between companies, etc. Another part of AI is going to be the automation, the productivity increase, etc., and will permeate a lot of sectors. And of course, a third part will be the part where humans become less involved. And I think the regulation aspect will be very wary about that last part. Particularly if you take the financial industry, regulators will be very wary of decisions that are made by the machine on its own and in an evolutive way, which is what AI will do. So I think we have to distinguish. It's not one size fits all, if you want.
Certainly not one size fits all when it comes to investing in Chinese risk assets more broadly. What are your views on how the recovery is going? What opportunities there still are? And I guess what the next catalyst might be for adding to positions as part of that China story?
Very interesting point. So 5% growth in a world that's decelerating or is going to decelerate is actually quite attractive. Number two, there are different factors at force after the initial, if you want, reopening and the normal tendency to go to service. So, you know, you're out of lockdown, you go and get a haircut, you go to the restaurant, etc. We now have that second phase, and the industrial side has not really picked up. Two things, clearly the external pressure, we've seen it with the export numbers, that is putting pressure on domestic industrial companies that are involved in the global supply chain, if you want. You also have a trending down factor in consumption with people perhaps uncertain about job. What is the conclusion of all this? Bad news is good news. What do I mean by that? If there are pressure that are too negative in the domestic economy, I really believe that the government will come in with support measures, but in a much more, I would say, delicate way than what we saw in the post-08 crisis. So it's going to be much more targeted. And of course, the long-term build around AI, technology, infratech, innovation is a theme that we like very much in China that is still massively underestimated.